Well, for more videos, please subscribe to my channel. And now we are going to discuss about the concept of business economics. Business economics is a field in applied economics which uses economic theory and quantitative methods to analyze business phenomena. Business economics is also called as managerial economics, and it is generally concerned with economic issues related to business organization, management, and strategy issues. And now, when it comes to the definitions of managerial economics, we have kind of definitions by Professor Spencer Segelman that managerial economics deals with integration of economic theory with business practice for the purpose of facilitating decision making and forward planning by management. It is all about integration of economic theory with business practice. And whereas Professor Hurst states that managerial economics is concerned with using logic of economics, mathematics, and statistics to provide effective ways of thinking about business decision problems. It is just all about logics of economics, mathematics, and statistics discipline to provide effective ways of thinking about business decision problems. And according to Professor Geraldine, the purpose of managerial economics is to show how economic analysis can be used in formulating business policies. Okay then. Now, while speaking about nature and characteristics of managerial economics, firstly I would say that managerial economics is microeconomic in character. Dear viewers, you all know that microeconomics is a study about the individual units of an economy, whereas similarly managerial economics studies about the firm as a single unit. So it possesses the nature of microeconomics. And managerial economics belongs to normative economics rather than the positive economics, which is also sometimes known as descriptive economics. In the case of law of demand, economics just explains how the price determines the demand but doesn't explain outcome is good or bad. And here comes the role of managerial economics. It actually concerned with corrective measures that a management undertakes under various circumstances. And it is also considered as a pragmatic science or pragmatic discipline. Managerial economics is pragmatic. In pure microeconomic theory, analysis is performed based on certain assumptions which are far from reality. But whereas in managerial economics, things are based on the reality and the real world decisions will be taken in consideration in the managerial economics. Managerial economics uses theory of firm, which is also known as the firm or economics of the firm. Generally, the scope of the managerial economics is very limited compared to economic theory, since it is only related with the behavior of a firm in an economy. And also managerial economics takes the help of macroeconomics. Managerial economics incorporates certain aspects of macroeconomic theory, knowledge of macroeconomic issues such as business cycles, taxation, taxation policies, industrial policy of the government, price and distribution policies, wage policies, and anti-monopoly policies, and so on, is integral to the successful functioning of a business enterprise. And finally, managerial economics aims at helping the management. It means like supporting the management in taking corrective decisions and charting plans and policies for the future. And here comes the scope of managerial economics. The scope of managerial economics is so wide that it embraces almost all the problems and areas of the manager and the firm. It deals with demand analysis, forecasting, resource allocation, production function, cost analysis, inventory management, advertising, price system, capital budgeting, etc. However, the scope of managerial economics may be discussed under following points. The first one is demand analysis and forecasting. Demand analysis helps to identify the various factors influencing the demand for a firm's product, and thus here the factors influencing the demand can be understood as the price of the commodity, price of the related goods, income of the consumer, and so on. These all are the factors which actually determines a demand in an economy. And the demand, as I said, demand analysis helps to identify the various factors influencing the demand for a firm's product and thus provides a guidelines to manipulate the demand. Forecasting is all about market prediction and behavior of the market forces. Demand analysis and forecasting therefore is essential for business planning and occupies a strategic place in managerial economics. Cost and production analysis. Generally, production deals with the physical aspects of the business and business investment act. And production is a process whereby inputs are transformed into outputs. Efficiency of production depends on ratio in which various inputs are employed. Here, inputs are called as factor. These are nothing but factor inputs. Are also called as factors of production, such as land, labor, capital, and organization. A production function is the relation which gives us technically efficient way of producing the output given the inputs. The firm must undertake cost estimation and forecasting to judge the optimality of present output levels and assess the optimal level of production in future. Here comes the inventory management. Inventory is nothing but stock of raw materials, and if there is a higher inventory in the firm, it leads to a higher production. If the inventory is low, it hampers the production. And managerial economics with various methods helps to minimize the inventory cost and maximize the benefit, that is increase the production. Advertising. Managerial economics helps in determining the total advertising cost and budget. The measuring of economic effects of advertising inform an integral part of decision making and forward planning. Market structure and pricing policies. Managerial economics helps to clear surplus and excess demand to bring market equilibrium. Guys, equilibrium is a concept where in an economy, when the market forces becomes equal, what are the market forces? That is demand and supply. When the demand becomes equal to supply, it is a kind of concept called as equilibrium. And here managerial economics helps to clear surplus and excess demand. That is, when there is a heavy demand in the economy, it helps to bring the equilibrium. And success of business firm depends on the correctness of price decisions. It is everything. Any success of a business is just, you know, I mean, mostly and largely it is related with the price decisions. And here price theory works according to the nature of the market, depending on the number of sellers, demand conditions, etc. Resource allocation. Managerial economics, with the help of advanced tools such as linear programming, are used to arrive at the best course of action for the maximum use of available resources and its substitutes. I am not going to explain it very deeply since these are very basic concepts, and I'll move to the next videos. And as in the following videos, I am going to explain you briefly about various concepts of economics, since I am very much related with economics rather than in the management. So I'm just focusing on the kind of definitions. You just, once you can read, you can just understand these things. And now this is capital budgeting. When managerial economics plays a vital role in capital budgeting, where generally capital is a scarce in nature and it costs something. Hence, managerial economics helps in decision making and forward planning and allocation of capital to various factors of production, marketing, and management. As I told you, since I belongs to economics discipline, you can have a more and clear cut videos in the following, more and clear cut concepts in the following videos.